this is dollars, and this is the interest rate. This loan's 10 million. This loan's 5 million. I got another one for 20 million. I got another one for 10 million. And these are all different loans, right? If you add up all the loans that we've originated, it adds up to $100 million. Now, what I do is I find outside investors to invest their money into this fund. And then I go out and loan it, right? So I've got a pool of money from my outside investors, and I loan it in this $10 million chunk. I loaned it to this borrower. So this $10 million loan, I originated at 8%. This $5 million loan, I originated at 9%. This $20 million loan was 7%, and this $10 million loan is at 10%. Let's say that all of the rest of the loans that I did were at 8%, just for simplicity's sake. So I got $100 million worth of loans out there that are all paying somewhere between 8 and 10%. Let's say I had one investor that was my seed investor. He's the guy that helped me start the fund, and he invested 50 million bucks. And then I got 20 other investors that each invest 2.5. Big investor, we'll call him Mr. Morgan. He says, Trevor, I helped you start this company. I am the biggest investor. I have the most at risk. I should be paid before anybody else. There's a term out there, first in, first out. That means I'm the first guy to put money in. I'm the first to get paid. I get paid before any investor. It's a win-win for him. I got to start this fund. I got to loan out $100 million at an average coupon of, let's say, 8.25. I got 51 investors here. And instead of them investing in individual borrowers, they're investing the whole fund. But Mr. Morgan, he wants to be paid first. Now, I'm going to have two, what we call tranches. We're going to have Tranche A, we're going to have Tranche B. So Tranche A gets this first bit of cash. And then Tranche B gets this bit of cash. We have two tranches. So we're making 8.25% on our money, and the first 3.5% goes to Mr. Morgan, who bought all of Tranche A, and Tranche B, they're getting 4%. And then whatever's left over is called the residual, and we keep that. We, the owner of the residual, we're basically making the spread. Our cost of funds was 7.5 from our investors. We originated a pool of loans at 8.25, and we get to keep the difference. Let's say the teachers' pension fund just put out an announcement that they want $1 billion worth of investments, and they need to make at least 3%. And Mr. Morgan says, you know what? I'll sell it. I got my return. I helped you start your company. I made some money. I'll sell my tranche to that pension fund that's looking to buy a whole bunch of these tranches. And so what will happen is another pool of loans off somewhere else is a giant pool, and this thing's got like 1,000 loans in it, has 10 slices of funds just like mine. And it's all these different A tranche, A tranche, A tranche. This is from my fund. This is from somebody else's fund, somebody else's fund. These are all from somebody else's funds. And so Teachers Pension Fund just bought a new pool of all these different loans, but it's really just pieces of loans. When you hear the word tranche, what they're talking about is basically some place in line of a pool of a whole bunch of different loans. So you're getting a slice of a fund. You're getting the least risky slice or the next most risky slice. And what I created here when I sold these tranches is called a mortgage-backed security, asset-backed security. It just means a pool of loans that's backed by something. This tranche right here It's the safest. So we would say that's the AAA tranche. And then this would be rated maybe BBB. This tranche has the highest rating because it's the lowest risk. These investors that bought into this tranche, they require a higher return, risk and reward. Remember, they're taking a little bit more risk. They want more reward. So they're getting 4. This tranche here went into this thing, and this whole thing paid a coupon of, say, maybe 3.4%, because it was made up of all AAA tranches. But the sponsor needs to take a cut, so they probably took that 0.1. Tranche B went into a different pool that looked just like this. It was all made up of B-level loans. But what happened was, I think it was right around the early 2000s, Standard & Poor's and Moody's, who were the 2 primary ratings agencies, they both went public. They used to be privately held, family companies, and they both went public. So what happens when you go public? Now you have investors. You've got outside stakeholders, you've got shareholders that are demanding you get a higher return. This was a $100 million pool. This one was 1,000 loans. This is a $1 billion pool. Moody's and Standard & Poor's, they get paid basis points based on the size of the investment. So a rating for a larger investment, they can charge a higher fee. And they would start competing. And what started happening behind the scenes is the guys at Moody's are like, let us rate that next bond that you issued. We have an incentive, because if we get this pool, we get a bonus. Maybe instead of rating that a BBB, we'll just rate it at a AA or whatever. There became a conflict of interest because now they were more profit motivated than they were objective. And so over time, the ratings agencies were like, this is probably a AAA here. This is probably a AAA as well. And more often, what you would see is these bonds that were made up of all these loans that were often made up of tranches started getting AAA ratings. The loans that we were selling to Lehman Brothers that were all subprime loans were going into mortgage-backed securities that were eventually getting AAA ratings. Now, this is where it gets really crazy. This tranche here, this is the residual. This was what the company was holding on to. This was basically their profit. They started putting these tranches into securities. And this is by far the riskiest, right? If a borrower is subprime and he's got a 25% chance of default, this is the tranche that's going to get affected. They were taking these, putting them into another pool, and guess what the ratings agencies are rating them? AAA. You've heard of derivatives, right? Credit default swaps. If I was an investor and I bought this thing here, this pool of tranches that's clearly more risky than AAA, this is the AAA tranche, they would sell me insurance called a credit default swap that says, hey, if this thing defaults, you can swap it out for this insurance policy. So if I'm like, oh, I can buy a tranche that pays, let's say, 4.5 instead of 3.5, rated AAA, and for just a few more basis points, I can buy insurance, why not? Once derivatives started coming into play, it was like putting everybody on steroids, and money just started flowing in to the bond market, these mortgage-backed securities. But the quality of these pools, these bonds, was getting lower and lower, but they were still getting AAA ratings. So you had conflicts everywhere. Eventually, the whole thing came crashing down because once this one defaulted, then the guys that held this insurance policy, they got screwed because they had to pay the investor. $80 billion pool just defaulted. The investor says, hey, I got a credit default swap, pay me my $80 billion. And so suddenly these guys are out $80 billion and a pool that they can't get rid of because it's made up of all these defaulted borrowers. The point is to give you a peek behind the curtain of debt funds and tranches and securities to understand how all of that flows. And that concludes our lesson for the day.